Are you in a short-term cash crunch and you need to figure out how to get some money quickly without creating a large taxable event by liquidating a bunch of your investments? Hi, my name is Zach Morris, and I'm a founder of Paces Very Wealth Advisors. Today, I want to talk to you about 4 strategies that you can use to come up with cash on a short-term basis. And today, we're going to use the example of making a down payment on a home. So, the 4 strategies that I want to talk to you about are home equity line of credit. I also want to talk to you about something called a non-purpose margin loan, an intrafamily loan, and also taking a rollover withdrawal from your IRA. For today's illustration, let's assume that Bob and Jennifer are buying a $1.5 million home. And in order to do so, they need to come up with $225,000 for the down payment on their new home. Now, they'll have this money when they sell their current home, but right now they're in a cash crunch because they haven't sold their current home yet, and they've got to come up with the money for the down payment on their new home. Now, Bob and Jennifer have a joint investment account with $2 million in it. Jennifer has an individual retirement account with $500,000 in it. And they also have a wealthy uncle named Jim, who I will get to in the last strategy. So the first strategy I want to talk to you about is a home equity line of credit. So Bob and Jennifer have a current home. It's worth $1 million, and they have $500,000 worth of equity. So they only have a $500,000 mortgage on the home, and they have $500,000 worth of equity. So they've already been underwritten for the purchase of their home of $1.5 million. And they can go back to the mortgage underwriter that did their mortgage for their new home, or the underwriter that does their mortgage for their previous home, and they can ask for a home equity line of credit. They only need $225,000, and they have $500,000 in equity. So this will still keep them under a 85% loan to value, which is what a lot of lenders look at, right? So they have $500,000 worth of equity. If they take out $225,000 line of credit on their current home, it'll put them at $725,000 worth of total debt. So a lot of lenders look at 85% loan to value, so they would be below that. And if they were to add that to their current debt to income ratios, so their current lender is going to be looking at them taking out new debt, right? It's something that they're going to have to disclose to their current lender. They're going to have to say, okay, we are taking out a home equity line of credit. Do we still qualify for this mortgage? Right? So they can't just take on more debt without being re-underwritten. And that's why it's not a bad idea to use your current underwriter, because they can just add those numbers together. Right? And if you qualify, then that lender would be happy to add more debt. Mortgage people are always happy to lend you more money if you qualify to pay back that loan. So they take out a $225,000 home equity line of credit. They put the down payment on their new home. Then when their home sells, they pay off their home equity line of credit and their mortgage on their previous home. So the next strategy I want to talk to you about is something called a non-purpose margin loan. So remember, Bob and Jennifer have a joint investment account with $2 million in it. But if they were to sell investments, they would create a taxable event, right? And they don't want to create a taxable event knowing that when they sell their current home, they're going to be able to fund the down payment of the purchase of their new home. Right? So all they need is short-term cash. Most custodians allow for up to 50% of the value of the portfolio to be borrowed against. Now, this is not something that we ever recommend, because if you borrow enough and then the market drops enough and your portfolio goes down in value, you can get what's called a margin call. And if you get a margin call, you're going to have to sell investments at the lowest possible point to fund the debt that you have, because the custodian is going to make you cover some of that debt, and you're going to do it through selling investments. Now, $225,000 borrowed against a $2 million portfolio is never something that I'm concerned about, but it's also something that I typically like to see repaid in a reasonable amount of time. So in this example, they get margin applied to their account. They borrow $225,000 with a non-purpose margin loan. And then when their home sells, they just put that money back into the account. And every dollar that goes into that account from that point until the margin is paid back will just go toward paying that margin loan back. The next strategy I want to talk to you about is what's called an intrafamily loan. So you remember they had a wealthy uncle named Jim, right? And so they can go to Jim if he's willing to do it and ask to borrow the $225,000. Now, they're going to want to make it worth his while, right? And also, if Jim gives them that money and says, just pay me back whenever you can, it can be considered a gift in the eyes of the IRS. So the way to do it is to structure it with what's called the applicable federal rate. So if you go to www.irs.gov/applicable federal rates. Every month they put out new applicable federal rates, or AFRs, and you can look up the short-term, medium-term, or long-term rates. Let's just say, for sake of example, that they're asking Uncle Jim to loan them money for a 12-month period, right? So a short-term loan, and they're going to base it on the applicable federal rate for short terms. Now, most attorneys and CPAs, and you should always do this in conjunction with an attorney and a CPA, most would tell you that you want to use 110% of the AFR or 120% of the AFR. And that way it takes out any doubt that this is a gift, right? You don't want to do the bare minimum. You maybe want to do 110% or 120%. You could have it structured as a interest-only loan with a balloon payment at the end. So they would pay interest only for 12 months, and then they would have to pay back all of the principal in that 12th month when the loan matures. But you probably want to put in no prepayment penalty, because Bob and Jennifer are going to pay back Uncle Jim when their current home sells. So they don't want to have to pay a penalty if they pay him back early. This can all be done in conjunction with an attorney and a CPA, and an attorney can write up the documents so that Uncle Jim feels comfortable that his loan is not only collateralized, but he has recourse if he's not repaid. Or maybe Uncle Jim is very generous and he wants to loan them the money for the whole house. Well, in that case, he could use the applicable federal rate and come up with a 30-year rate and basically amortize it over that 30 years, just as a mortgage would be. Bob and Jennifer can then take that as a mortgage interest deduction because it would be filed as a mortgage with the state. The last strategy that I want to talk to you about is withdrawing money from your IRA. Now, the IRS allows for one rollover withdrawal per year. Now, this is different than a direct rollover when you take money from your 401k and it's rolled directly to your custodian. So the check is made out to the custodian for the benefit of you, right? So that's what's called a direct rollover. If you took that money directly from your 401k and they made the check out to you, you would then have 60 days to roll that money into another IRA. If you take that money out of your IRA and you replace it within 60 days, it can be classified as a rollover instead of a withdrawal. Now, the rollover or the withdrawal is going to be reported on the 1099-R, and the contribution is going to be reported on a 5498. So it's up to your CPA, and it's up to you to communicate this with your CPA that this is what you did and this is how it should be reported. Now, I caution you that if you miss the deadline, you will actually have to pay taxes as if it was a withdrawal, and you'd have to pay ordinary income. If you're before the age of 59 and a half, you will pay ordinary income as well as penalties because it would be considered an early withdrawal from your IRA. Of course, this is a strategy, just like many of these others, that I advise that you do in conjunction with your CPA, and you communicate with them as you're going through this strategy. I hope you found this video helpful today. And if you did, please give it the thumbs up below and subscribe to the channel. And please be on the lookout for more videos from this channel. Thank you.